Hey, Dan Passarelli here. In one of our classes at Market Taker Mentoring, I was talking about trading straddles the other day, and I discussed and traded Strangle, which is the close cousin of a straddle in Alibaba. And I was managing some trades today, and I thought that this would be a great opportunity to talk about managing straddles and strangles. With straddles and strangles, we want the stock to move a lot. In fact, we want it to move far past the strike if we're talking about straddles, or past, well, both of the strikes if we're talking about strangles. And we want it to move as much as possible. With a lot of trades, we use stops, right? You've heard of stop losses. Those are mostly for directional trades. But for something like a straddle or strangle, we can't use a traditional stop loss because the only way the trade loses money is if too much time passes and it loses money as a result of theta. So our stop loss with straddles and strangles has to be what I call a time stop. We say if this many days passes and we don't have a profit, we're going to close the trade. Another thing we have to consider when it comes to managing straddles and strangles is if the stock moves away from the strike, but then it moves back, we know that that's a pretty good indication that we could potentially be erasing some of the profits that we may have had, and we might want to jump in and take a look and see if it's time to close the trade for a loss as well. Now, the final thing is implied volatility. Straddles and strangles are pure volatility plays. They work out a little bit better in down markets because when stocks go down, their implied volatility tends to go up. So even though these are typically delta neutral trades, there could be a little bit of a downward bias because the position could be helped out a little bit when the stock is heading down. I wanted to share those thoughts. This is Dan Passarelli, Trade Smart.